Hi, I wanted to make a short video to talk about the cap and trade system that we have in the United States that works really well. The first attempt to include legislation for a cap and trade system was in the 1979 amendments to the Clean Air Act. What those amendments did was develop something called the bubble concept. Now imagine that a factory has 15 or 20 smokestacks. And command control regulation would require that each one of those meet the regulatory standard for emissions, under this much or whatever. But with the bubble concept, it puts a bubble over all of those, and then it measures the emissions from a single vent. So if one of the smokestacks was exceeding the regulatory standard, that was okay as long as another one wasn't, and it was under the standard by a sufficient amount to offset the excess from the first one. So that on average through that single vent, the emissions levels were within the limit prescribed by the Environmental Protection Agency or whatever other health agency might be doing that. So that allowed sort of like trading between smokestacks of a facility. And you can imagine this over a region where companies could trade off. And there was a provision that would allow some sort of payment, but this wasn't developed very fully at that time. At roughly the same time, the Canadians were getting really upset about acid rain. The electric generation plants in the eastern part of the United States burn relatively high sulfur coal, and that emission of sulfur dioxide created atmospheric compounds that led to acid rain or acid snow, which was acidifying lakes and streams in Canada. And it also did some damage to forests and whatnot. So the Canadians were pretty upset about this. In fact, this was a big issue for them, although it wasn't on the U.S. radar at all. So in 1990, when the Clean Air Act was amended yet again, they included a provision that would reduce sulfur dioxide emissions by 50% from 1990 to the year 2000. This is a huge target, right? Cutting it in half in 10 years. To do that, they developed a trading system for those East Coast or Eastern coal-fired power plants. And there was a 5-year preparation period, so the first trading would take place in 1995. In 1991, the Canada-U.S. Air Quality Agreement was signed, and that added nitrous oxides to the mix of pollutants that would be controlled. So in 1995, trading begins, and it turns out there was less trading than anticipated, but the reductions of SO2 exceeded expectations, and there were savings compared to command control regulation of several $billions a year. So higher air quality than expected at lower cost than would have been required with command control regulation, although the trading was lower than anticipated. Trading was part of it because trading allows companies a certain amount of flexibility. In a paper that a friend and I wrote, we found that some companies postponed their reduction efforts, thinking that because of innovation, the technologies that reduce pollutants would be better and cheaper in a few years. So they chose to buy allowances from other companies. Those companies that had low cleanup costs would clean up in excess, creating allowances that they could sell. So trading did allow some flexibility. Now, at the same time, it turned out because of that 5-year lead time, engineering companies or environmental engineering companies were able to find ways to reduce emissions at much lower cost than anticipated. And finally, the third contributing factor was the low sulfur coal from the west was more available and at a lower cost than had been predicted in the model. So these three things combined, trading being one of them, to reach those very stringent air quality standards at a lower than anticipated cost. In markets, supply and demand have to match to get clearing, and it doesn't happen all the time. That's why we have sales and whatnot after Christmas and so on. In this case, we had excess supply, and those emissions allowances could be banked, and there could be a problem here where if a environmental engineering company that was working on developing new technology saw that there was this excess surplus of allowances, so the market for their particular product was smaller than they thought it should be, they might not invest as much in research and development as would be ideal. So having banked allowances that don't expire very quickly, can be a little bit of a problem. One thing you need to know about cap and trade is that it only works if across the companies or the facilities being combined into the market, there are different cleanup costs. So you need some companies with low cleanup costs, others with higher costs, and that's what creates the incentive to trade. Those companies with low costs of cleanup will clean up beyond what's necessary for their internal needs and sell the excess allowances. High cleanup companies will be the source of demand because they'll be able to buy allowances cheaper than they can clean up themselves. So if you don't have a range of cleanup costs, things aren't going to work right. In the U.S., because there were power plants of different ages using different sorts of generation technology and so on, there were a wide range of cleanup costs, and a market was able to form. Finally, let's look and see what the effect has been. I've already told you that pollution was reduced more than anticipated, so you kind of know what the punchline is. These maps show in red high concentrations of sulfur dioxide in the atmosphere, yellow less concentration, and you'll see that it changes over time. Remember what the timing is. The rules were promulgated in 1990, trading began in 1995, so companies had a lot of time to get ready. So let me go through these maps real quickly and we'll see what happened. So here the Clean Air amendments are promulgated, companies are kind of getting ready, and then trading begins right here. And we have one outlier in Ohio, but even that plant manages to clean up for a few years. And we have largely eliminated those high concentrations of sulfur dioxide now. And you can see there's some pale yellow patches, but very little red except in that one place. So there we are, a great example of cap and trade. The market still exists, and in fact it was expanded to include some Western utilities, and the cap was lowered, I think, in 2005. That's how cap and trade works, right? You set a cap that satisfies the regulatory standards that you want to meet, and you can lower that over time to make air quality better and better. So thanks for watching this, and I have a second video that explains the emissions trading exercise we're going to do this week. Bye-bye. Thank you.